I'll own some Bitcoin, some Solana, some Sui, and some ETH, and I'll be fine. And you'll be absolutely fine. Again, if you're doing degenerate stuff, do it with the small stuff, even with the DeFi stuff. Just don't lose control of your tokens. The longer term time horizon.
These are difficult times for cryptocurrencies. Every day brings bad news, and the weekly outlook is bleak. Bitcoin's price has fallen almost 13% this week. Ethereum and XRP have lost almost 15%, while Solana has lost a staggering 21%. With Bitcoin struggling to stay above $92,000, some analysts anticipate further declines, while new investors are selling off en masse. This Bitcoin plunge means it has virtually wiped out any gains made in 2025. A report from CryptoQuant indicates that retail investors sold a significant amount of Bitcoin once prices fell below their break-even point, suffering heavy losses after buying at the peak. Surpassing the $100,000 mark appears to have triggered widespread panic among new holders, leading to a wave of capitulation. This wasn't profit-taking, it was massive losses on a monumental scale. CryptoQuant analyst CrazyBlock stated that despite short-term difficulties, the transfer of Bitcoins from distressed sellers to more stable investors could help establish a more solid market base. However, according to macroeconomics expert Raoul Pal, this could be a short to medium-term transitory phenomenon and not alter the overall trend. According to Raoul Pal, you can stay relaxed if you follow this key strategy of Ethereum and Solana. Before we move forward, if you want to stay updated with the latest crypto events and news, you can subscribe to our channel and like this video. Now let's get back to Raoul Pal's view on Solana and the overall crypto market.
Everybody thinks that this time is not different, and they're right. You see, what the misunderstanding is it's not the length of the cycle that we should be looking at. It is the debt maturity profile that is not different. So it is extended, and that is what drives markets. So that's the part that's not different, not the 4-year cycle. It's not some magical from the heavens. Satoshi came down and delivered 4 years of magical money. The magic internet money rains on us every 4 years, and we must harvest this 4 years. I mean, no, it is to do with the debt cycle, and I'll come on to that again. But, you know, I kind of love watching sentiment because, as I said, I understand all of our hopes and dreams are in this trade. Our hopes and dreams, the banana zone, all of these things, they're all like, please, please, please. And it always feels like we can't. But what happens is I start to monitor that sentiment. And when the sentiment starts getting completely wild, then I know that we're probably closer to a bottom. Zoom out, expect pullbacks frequently. Here we are. You should be begging anybody for money right now on the streets. Maybe if you can play guitar, do something, stand on your head for 10 minutes, anything, just get some money and put it into the markets. We had a perfect 4-year ISM cycle that changed, and it's driven, the cyclicality of the economy is driven by the debt maturity distribution. So the debts have to be rolled, and we need to, because going back to this chart, if you remember, we pay it by debasing currency. And so when the debts get rolled, currency debasement increases. And that is the process by which markets and economies have operated since. It's all the same cycle, and it happens globally. So up until 2024, we had this perfect 4-year cycle. I mean, perfect. And that was because the debt maturity of the debts after 2008 was 4 years.
Paul believes the cryptocurrency cycle is not nearing its peak, but rather entering a longer and more powerful expansion phase that could extend into 2026, driven by increased global liquidity linked to sovereign debt dynamics. Liquidity is the primary driver of the cryptocurrency market. The most important macroeconomic variable of all time, Paul stated, is the increase in liquidity by governments and central banks around the world to manage debt at a rate of 8% per year. He distinguished this ongoing monetary depreciation from measured inflation and urged investors to think in terms of minimum required rates of return, not headlines. Any investment we make must achieve a minimum rate of return of 11%. If our investments don't reach that level, we become poorer. Paul categorically refutes warnings about a tech or cryptocurrency bubble. He argues that we are staying within normal trend limits. According to him, price-to-earnings PE analysis overlook the influence of currency depreciation on prices. He also points out that Bitcoin follows its trend lines without reaching extreme highs. He connects all of this to global liquidity and debt cycles. His analysis presents current prices not as irrational, but as determined by precise mechanisms. Paul asserts that we cannot speak of a bubble in the markets as long as tech and cryptocurrency stocks remain within one standard deviation of their long-term trend. Furthermore, he highlights Bitcoin's position relative to the trend. He states that Bitcoin is currently less than one standard deviation away from its long-term channel. He predicts that historically it typically reaches 2 standard deviations, implying significant upside potential. Therefore, according to Paul, current cryptocurrency price levels are not the result of excessive speculation. They are mechanically linked to currency devaluation and the mismatch between income and inflation. Following the end of the latest partial U.S. government shutdown and with markets once again focusing on macroeconomic issues, Raoul Pal has outlined a roadmap decidedly focused on liquidity with direct implications for cryptocurrencies. Now that the U.S. government has reopened, what's next? Paul asks. He immediately mentions the General Treasury Account, GTA. We should expect GTA spending to begin significantly increasing liquidity in the coming days, and this effect should continue for several months. Of course, quantitative tightening, QT, will end in December, and the balance sheet will gradually increase. We should observe further depreciation of the dollar. Meanwhile, the Federal Reserve has already confirmed that quantitative tightening, QT, will end on December 1st, 2025, transitioning from actively reducing the balance sheet to fully reinvesting maturing Treasury securities and implementing a more cautious policy. The short-term risk, he asserts, is a classic year-end funding crisis. The next crucial step is to avert such a crisis. Here he refers to term repurchase agreements and the standing repurchase agreement, SRA, which the Federal Reserve can expand to ensure banks have access to liquidity in the event of a sharp increase in overnight interest rates. This interpretation aligns with recent communications from the Federal Reserve, which indicated that increased use of the supplemental risk, the SLR, is expected to lower interest rates in the first quarter as banks purchase more bonds. The SLR limits the overall size of large banks' balance sheets regardless of the risk associated with the assets. Easing the rules on Treasury bills and reserves have been debated for years. This measure would allow market participants to hold more government debt securities without violating regulatory restrictions. If regulators act in this direction, as Paul points out, it would free up banks' capacity to buy more bonds and could put downward pressure on yields, thus contributing to improved financial conditions. For cryptocurrencies, Paul's main macroeconomic thesis is based on the idea that greater liquidity and lower real yields are the primary drivers of digital asset growth.